Welcome, everyone, to another edition of the Tony Sirianni podcast. I am thrilled to have our friend Bill Hornbarger, who's the Chief Investment Officer at Benjamin F. Edwards, with us today. Welcome, Bill.
Thank you. Thank you very much for having me.
So I'm going back and forth with this beard today, so I have some issues around that. I'm not sure you could solve those, but maybe we can talk a little bit about the economy.
Sure thing.
So I don't know if you're aware of this, but in 2 weeks there's an election for the president of the United States. So that's something that's going on. I'm wondering if that has an impact.
Certainly it has an impact. And I think, it's nuanced, right?
Yeah.
I think it certainly right now, I don't think it's any surprise to anybody that we've had a relatively contentious election cycle, a lot of negative rhetoric from every corner of the world surrounding the US presidential election. And I do think that depresses confidence a little bit. And I think it gets people's emotions running a little high, keeps people a little bit irrational. Look, coming out of this election, I think there's a couple of big topics as it relates to the economy. One of them is immigration, obviously, and the other one is probably tax policy. I think either candidate is probably going to continue to add the deficit based on the policies they put forward. So I do think there's going to be an impact. I think right now it's, where we are is we have to wait and see who wins. And then we're really going to have to dive into what their policies are going to look like.
Yeah. It's interesting. You said immigration. I was just, reading something. The economy in the last 3 or 4 years hasn't behaved the way we would expect it to, right? I mean, there's been differences. So, jobs are, they're not, remember the Phillips curve. I mean, they're not tracking the Phillips curve. I mean, rates are doing one thing, but jobs are remaining stable. Some of that's due to immigration. I just trying to figure out, that's one thing. So let's talk about that one first. So jobs, that's not tracking.
So I think, it's a great question. And look, if you look through the history of the world, one of the biggest economic drivers is population growth, right? And, let's be honest, in our country and a lot of countries around the world, people aren't having as many children as they used to have.
Yeah.
And so I think one of the ways to think about, population growth as it feeds into economic growth is immigration. We need a good immigration policy, right? And I'm not making a political statement on either side of the aisle here. I think we need a good immigration policy. We want more people in our country. We want productive members of society. We want them working. We want them paying taxes, all those types of things. And so I think that's one of the big things that's going to happen in this election. To your previous point, the Fed's raised rates a lot. The unemployment rate has gone up, but it hasn't gone up to the degree that we might have thought with 525 basis points of tightening under its belt. And I think there's a lot of reasons for that. I think, part of it's kind of the shifting nature of the economy, right? A lot more service jobs, less manufacturing. There's a lot of studies out there that say the jobs that have been created maybe aren't, the highest paying jobs, but for whatever reason, we remained at, pretty close to what I think most people would consider full employment, despite pretty aggressive actions from the Fed. That's a good thing in our opinion.
So that you don't think is a future, I mean, I guess people have to behave a certain way for all those jobs to turn into inflationary pressure, like savings and stuff like that. That has to happen. So you hit a little bit on government spending. Some of this is related to the election, but that seemed to be the initial catalyst for inflation, right? You just threw a lot of oil on the fire, but it's still growing, and so that's another thing that hasn't acted in a way that traditionally you would say these things, react. You would have thought all this government spending created inflation. Now it's going to be, we have an inflationary environment and everything's going to be bad, but they're still spending, and now they're cutting rates. So
no, it's good, right? I mean, and it's a very unique economic cycle. I think, but every economic cycle is unique, right?
Yeah.
This time it's different, right? So I think again, a couple things to think about there. You know, one of the things that we saw in this cycle, and you've mentioned inflation, right? CPI peaked at 9.1%. I think, was it 2022? I think COLA adjustments at the government level were 5.7%. Everybody's like, oh my God, it's great. But we had negative wage, real wage growth, right? And that was a problem for a lot of people. And I think now what we've seen is we're back with inflation coming back down. We've got positive real wages right now, after a couple of years of negative real wages. So I think if you think through the cycle, people were spending more because they were forced to, right? The cost of groceries going up, the cost of used cars going up, the cost of housing going up. I think most of us would think, just, think about what it costs to run your house and how much more it was in 2023, 2022 than it was in 2020, 2021. So you're forced to spend more. I think now we've got a situation, the unemployment rate is still relatively low. Home prices and stock prices at or near all-time highs. Positive real wage growth. I think people feel a little better about the world, right? Their balance sheets don't feel so bad with home prices and stock prices at or near all-time highs. And so I think now you're seeing people shifting a little bit from I have to spend more just to keep up to I've got a little extra. I feel good about things I can spend. So.
Right. And then so that ties into the other thing that was the big debate for years and based on, monetary policy and all that. So is there a soft landing? Is there such a thing? Is there a landing? Because aren't we supposed to have a recession if we raise rates to five, from 0 to 5, whatever, 5.25 now?
Sure. Yeah. So the mythical soft landing, right? And first of all, let's talk about, like, I think there's a lot of people don't understand what a soft landing is, right?
I
It's
don't.
the
So
Fed.
I clearly don't.
Yeah, and if you look at I don't think any of us do, right? We'll know it when we see it, right? Like
Yeah.
good art. I think a lot of people, the kind of the technical definition we use is the Fed raises rates enough where they can tamp down inflation without putting the economy into a recession. Okay. And I would say, Tony, up to and including today, right? No guarantee about tomorrow or next week. But I think the Fed's done a pretty good job of engineering something that looks and feels like a soft landing, right? They raised rates 525 basis points, stocks at all-time highs, home prices at all-time highs. The economy, I think if you look at the Atlanta Fed GDP now forecast, expected to grow at 3% in Q3. Positive GDP this year, forecast for positive GDP next year. Unemployment rate still low, 4.1%. But, right, not everything's moving in the same direction to the same degree.
Right.
In a soft landing scenario, there's going to be some things that aren't as good, right? Manufacturing's in recession, right? Has been for most of the last 2 years. If you look at the ISM surveys, and there are other warning signs out there. Leading indicators came out yesterday. They've been down 32 of the last 33 months, leading economic index. That's typically associated with the recession. You're at that point where the yield curve was inverted for 4 years. Now it's starting to steepen. That's typically the time so I think we would say that up to today, the Fed's been successful. We think they will continue to be successful, but there are certainly risks out there.
So some of the stuff seems like, just taking longer to have an effect because you raise these rates, but jobs have stayed steady. And we've also come through the last, like, say, 20 years or so, there's been bubbles, right? There's a housing bubble. So tech bubbles. I mean, you wonder, where are we bubble wise and something that could burst and then, get us into trouble.
Right, there's a reason they call them surprises, right? So nobody sees them coming. We think a lot about that. Let me just say one thing. I do believe, as it relates to the consumer, that one of the reasons the Fed raising rates so aggressively maybe didn't have the impact you would expect is I think so many people out there have sub 3, sub 4% mortgages right now. And
Yeah.
I do think that is definitely lessened the impact of Fed raising rates on the consumer and on homeowners. In terms of bubbles, right? It's really tough, right? I think a lot of people would look at stocks and say, oh, we're at all-time highs, we're in a bubble. They look at, some of the Magnificent Seven names, right? That feels too easy to me to say that that's the bubble.
Mm.
It's too easy. A lot of people point to Bitcoin. Back to something you mentioned earlier. I don't know if it qualifies as a bubble, but one of the things that I think people are increasingly paying attention to is the explosion of debt. Right? I just think 2024. I think the IMF projects global debt in excess of $100 trillion for the first time on record. You see a lot of people betting against the U.S. bond market, specifically citing deficits. I think that's one of the things that we really need to keep an eye on. I'm not sure that it qualifies as a bubble, but we're in the longest drawdown for the bond market on record
Yeah.
right now.
And and deficits, like as you said, with the election coming up, no one seems to be, wanting to rein that in. What happens in that situation when you talk about a bubble? Because I understand a tech bubble, been through that, understand
Sure.
home bubble that was not pleasant, but we did through that. So what happens typically in a deficit,
Yeah,
spiral?
Tony, it's a great question. I think people out there, I think a lot of people think there's going to be this great like, the big bang event where the U.S. is going to default and the dollar's going to collapse and everything. I would think more of it in terms of inflation, right? I
Yeah.
think we'll be able to service our debt even as it expands. I don't think there will be this big collapse where the U.S. defaults or anything like that, and suddenly we're thought of as a banana republic as it relates to the value of the currency. I think of it more in terms of inflation, that until and unless we get this under control, this explosion of credit, this explosion of debt and deficits, it's inflationary. And I think it argues for, on the margin, in and of itself, there's so many other factors that go into it, but higher yields than a lot of people would think. So I think that's one of the messages we're seeing in the bond market right now, right? The Fed cut rates 50 basis points. They've all but said they think they're going to continue to cut rates. And we've seen bond yields go up 50 basis points since the Fed cut. I think the focus is now back on deficits.
So, but there's a squirrely player there, right? So you've got the Chinese, right? There are foreign, it's the dollar's the currency, world currency. I mean, just travel anywhere, right?
Sure.
You say everything in dollars, and for governments. And China's such a weird actor because it's state controlled, that they clearly have an agenda to hurt America, that somehow they feel that helps them. So, and they control still, I mean, maybe I'm wrong about this, do they still control a bunch of treasuries? That's why they were selling some or whatever, but
Sure.
there's still players in that marketplace in not necessarily a positive way.
Yeah, it's interesting. The IMF, when they were talking about, you may or may not be aware, their annual meetings in Washington D.C. this week. So
Yeah.
there's some headlines from that.
I wasn't invited, by the way. I'm in
Yeah,
Washington.
either was I. Didn't make that list. So, but they specifically cited as two of the most egregious countries in terms of this explosion of debt, the United States. But they also mentioned China. China's got a lot of its own issues right now, in terms of its real estate market and what's going on there. And so I think, yeah, certainly a factor. But I think more than anything, I think people have woken up and they've said, you know what, long term, this isn't sustainable. We've always known that, but we're getting kind of closer. I'm going to use the term closer to the edge right now.
Yeah.
And so I think until and unless somebody steps up with a coherent, viable plan to figure out a way to rein some of this in, again, I think it's going to keep the pressure on the market.
Yeah. And another thing to go back to, I mean, the shift from China to a domestic. issue that keeps being brought up, and you keep thinking, well, they can't be serious about that, right? But they kind of seem like they are, is capital gains. And then somehow, I mean, we laugh. I laugh too. It seems stupid. I mean, I own a couple of companies, private companies. How do you? I don't understand how that's going to get taxed or what the, it just seems it makes no sense. Developed by people who don't understand how to run a business, right? I think that's fair to say. But what could possibly happen, there?
Well, so yeah, I think you're talking about, correct me if I'm wrong, the idea of paying taxes on unrealized gains.
Unrealized gains, yeah, right.
Yeah, and
Well, not only unrealized gains and then knocking up the capital gains, which seems to, a way to try to rein in, certain, tech, guys who get paid that way. I mean, just
well,
it's gonna hurt the guy with the plumbers and the small companies and the small businesses. That just destroys them.
yeah, I think, the idea of taxing, again, anything is possible, and we live in interesting times, right? And again, a lot of this, depending on who wins the White House and what Congress looks like, and one party. And I don't care what the polls and the betting market say. I don't think anybody has any idea what's going to happen on that day.
Yeah.
But the idea of taxing unrealized capital gains, I think the hue and outcry when that was suggested maybe a month and a half ago, I'm hoping people realize that that might be a bad thing. But again, anything's possible. But that would be a real game changer. I think it would. That would severely, I think, impact people's willingness to invest in equity in businesses. Right. I think it would
No
make
question.
debt financing a lot more attractive, and so we'll see that where that one goes. Raising the capital gains tax, again, I think it would have some negative impact on investment. I think a lot of that depends on what it looks like, how much, how is
Right.
it phased in, short term versus long term, who's impacted, right? There's a lot of thoughts on, wealthier people being,
It'll change behavior. I mean,
yes, without a doubt.
when you change policy like that and it affects people's investment decisions, you change behavior.
Yeah, but
Because
the taxing unrealized gains, and I don't even know how that works, right?
I don't know how it works either. That's
I
why
mean,
it
I
doesn't
own
make
a
any
stock.
sense.
I own a stock that's 50 on January 1st. I get taxed, and then it's worth 30 on December 31st. How does that work, right? Do I get a clawed back? That one just, it never made any sense to me. So,
No. Well,
but
that's
again,
another thing.
anything's possible in this world. So,
So one other thing we had talked about was and just trying to understand what it is the neutral rate. What is
mhm.
that and how does that work? And
Yeah, no, that's a great question. That's one we're spending a lot of time thinking about right now. So, so the Fed has, some mythical neutral rate where everything's in balance, right? They have inflation kind of at their target, and they want a Fed funds rate that's neither stimulative nor,
right,
or a dampener. And it's called the neutral rate. And, we're thinking a lot about where is that, we had 15 years of basically 0% interest rate environment, super aggressive tightening cycle. Now the Fed's easing. So the question is, I don't think anybody thinks they're going to go back to zero. So the question is, if the Fed is successful and they can engineer, an inflation rate over a cycle, core PCE at 2%, where do they feel the appropriate policy rate is that, again, in that environment, is neither stimulative nor
right,
dampening things? And, you know, you see some people say 2, you see some people say 4. I think there's a big difference in there in how markets behave and how people behave in
right.
those rates. The Fed itself has says somewhere around 3, low, mid to low 3s. We believe probably somewhere in that 3 to 3.5% range. We think is where that quote unquote neutral rate is, and you know, Fed funds will spend some time at that rate. They feel like they're always moving, but we think a lot about that, and we think that 3 to 3.5% actually would be a pretty good rate for investors, right? We
Yeah.
don't
I know
don't
people
think it's tough on stocks. We think it does provide a little bit of yield for people who want to own fixed. And so, but that's one of the things we're thinking a lot about now.
I can't decide whether I think that's like just the dream rate, or because it's been so long. I was a kid, but we haven't had inflation in a long time, so we haven't had this kind of. And the guy who played this game, Paul Volcker came in and just smashed everything around. But I forget what the number, like 18%, or some crazy number that he put in there. And how much time have we actually had at a neutral rate? I mean, because it was that in recent investing memory, it's all we've been playing with the rate to help us get out of a jam, right? So
Yeah, no doubt about it, right? You think you have a whole generation of people work in the industry that, 0% interest rates is where they started, and you think, oh, well, they're young. Well, yeah, that was 2009, right? It's 15 years ago.
yeah,
And so, no, you're right. We don't spend a lot of time probably at that neutral rate. I think of it as kind of the starting point, right, for a cycle, right? We're at that neutral rate. Inflation's too high. We go up from there. We're at that rate. The economy's a little soft. We go down from there. And again, I don't think anybody thinks we're going to go back to zero. But clearly the Fed thinks 5.25, 5.5 is too high.
yeah,
But you're right. To your point, it's we haven't. I mean, we had 15 years of extraordinary monetary policy,
yeah. Just
and
very different.
getting out of that, we all knew was going to be messy. And that's where we are today, right? Is that messy part of trying to get out of that. So
Yeah. Well, I mean, it's so we believe it or not, our time is coming up here, but it does seem like we've been in extraordinary times, and trying to use some of these traditional models or things that have worked for 30 years, or at least we've assumed they've worked. Things have been a little bit out of whack, and I don't know that you can emphasize enough what COVID and shutting down the economy and all those things did, because I think it was a tremendous. It shifted so much.
right. I mean, you think of COVID almost as analogous to wartime, right? The enemy was a virus, but you think like that. That's almost how the economy and people acted. Just very different. And to your point, it's changed a lot of things. And again, just one more thing to add to the fact that we for 15 years have really had really extraordinary policy, extraordinary times as it relates to the economy and the markets. And again, we've always thought getting out of that was going to be kind of messy and difficult. And I think that's where we are today, is
Well, so
trying to get out of that.
I said we were done, but one more factor that is out there and potentially weighing as a huge factor in the economy is AI. So
Sure.
not quite understanding. In our business, there's applications and people are already using it. So, how do you factor that thing in, which is a lot of unknowns, but
Well, we were talking about it this morning, that, the computing power, and, these chips are getting smaller and smaller and faster. And look, I think if you were to ask me, I would say that we're probably in the second inning in terms of thinking about the applications and the impacts. Clearly they're going to be big. Clearly they're going to be, I don't want to say life altering, but economy
disruptive. They're
altering.
going to be disruptive.
Yeah,
On some,
it is a big bang. And I think like everything, it's just going to make things faster, more efficient. Less people are going to be necessary to do things. Again, I think we're just starting to scratch the surface of it. We like everybody in our business, what do we do with it? Where do we go with it? How do we harness it? How do we use it? How do we use it productively? What does it mean for us? What's it going to cost us? And we're evaluating that because we see applications in what we're trying to do. And I think everywhere, everybody sees that, but still trying to figure it out.
yeah, yeah. Well, look, thank you so much for spending some time with us today and going over all this stuff. It was a lot of fun, and we'll do it again.
Awesome. Thank you, Tony.